Welcome to the Broken Pie Chart podcast, episode number 8. I'm your host, Derek Moore, and this week I'm going to be talking about valuation. Really, when we talk about valuation, more specifically, going to get into what's called the Warren Buffett Indicator or the Buffett Indicator. You know, anytime the market's reaching all-time highs, I often get some questions around, is the value too high? Is it not too high? How do you actually try and figure it out? There's things like the Shiller PE ratio, but this Buffett indicator, I've started to see articles on it, and so I thought it'd be worth doing a short podcast to get into it, how you calculate it, where you find the data, and maybe some pros and cons on it. Look, I mean, trying to time the markets is really difficult, and it's one of the reasons why I advocate to using strategies that have buffers or downside, caps or protections in them. That way, if the market continues to rise, you get to participate in it. If the market sells off materially, you are looking to stop the downside and contain it. But all of this thing called the Buffett Indicator, it actually started a long time. Well, I can't believe it's a long time ago. But back in 1999, and I'll link to an article on it, and I'll link to where you get this data. But there was an article that essentially summarized the talk that Buffett gave in 1999. You remember 1999 was really the last, full year of that strong 82 to 99 through 99 bull market. And then, of course, we had the tech crash that started in March of 2000, or the declines. But we keep, I hear about this, I get questions on it. It started from that article. And the article, I believe it was Forbes or Fortune, I'll link to it. It was explained that you could sort of have an idea of valuation by taking or dividing the total market cap of all stocks by the gross domestic product or gross national product. And when you do that, it produces a percentage, and it's sort of a valuation metric. And by the way, the total market cap, I'll link to it, as the Federal Reserve Bank, or Fed of St. Louis, Fred for short. It's actually listed as, I don't know why they call it this, but non-financial corporate business, corporate equities, liability level. In other words, what's the market cap? And then, of course, gross domestic product is a measure of the U.S. economy, all finished goods in the economy. Those come out quarterly. And so as we're sitting today in September of 2018, we are through the second estimate of Q2 GDP. Remember, the quarter ends, you get a first estimate, a second estimate, and then the final quarterly number. And so I'm going to write an article on this, and I'll post to it where I've graphed the percent market cap to nominal GDP. I put it in a graph. But just keep in mind, the numbers that we have are only through, that Q2. And so when this is produced, and by the way, you can, besides that kind of long-sounding thing, you can actually use the total market index, the Wilshire Total Market Index. But just keep in mind that, GDP is not updated daily like a market index is. And so if you really want to compare apples to apples, or I shouldn't say compare, but the two data sets, you can use those two I mentioned. But if you want to get an estimate of kind of on a percentage basis where it's going, you can use that Wilshire index, and maybe you can estimate where the nominal GDP will go. But besides how to do it, so again, it's taking the market cap using that number divided by the nominal GDP, and you come up with a percentage. And the higher the percentage market cap to gross domestic product, the more perceived it is to be overvalued. And the lower it is, the more it's perceived to be at a lower value. If we kind of think about historically, in the tech boom of the late 1990s, the ratio was up close to 160%, right around there. Prior to the Great Recession, it was actually, around 117 or so, just under 120%. And most recently, We've seen it go above 140%. So give you an idea, and you can look at the chart when I link to the article, I'll put it on there. But the idea is investors watching this ratio is that stocks are more likely to offer a higher probability of good returns when it is low and a lower probability of good returns when it's high. Now, I'll get to some of the sort of the cons of this, and I think this will be important, and especially important when we frame things around interest rates. As I think one of the limitations I see purely using this as a standalone is that it doesn't really alter itself or make an accommodation based upon what the interest rate is. And so, and Buffett talked about this as captured in the article about how important interest rates are, and I'll get to that for a second. But, well, actually, let's get to it now. So in the article, one of the things that Buffett did was he said, look, in the period 1964 through 1981, you had interest rates continue to rise. And then, and by the way, the Dow Jones, just looking at the index from 64 to 99, through 81, essentially it was zero. You had zero gain in the index, that excludes dividends. And then you have this period from 1982, beginning of 82 through the end of 99, and of course, early 2000 as well, where the market was up, not including dividends, over 1,000%. It was probably the greatest, one of the greatest, probably the greatest bull market period in history. There's really no other time frame that had those types of returns. And you think of 64 through 81, you saw interest rates going up. And I'll discuss in a second why interest rates matter with regard to valuation and future cash flows, i.e. earnings. To put this in perspective, in I think it was 81 or early 82, the 3-month Treasury bill, which by the way is used a lot as the discount rate or what we call the risk-free rate of return, was about 15%. Meaning you could buy a 3-month Treasury bill and get 15%. Heck, you could have bought a 30-year Treasury bond and gotten right around there. Imagine putting all your money in a U.S. government bond that's going to get you 15% a year. That's better than the average over 90 plus years in equities. So that tells you how high interest rates were. But from 82 through 99, we saw interest rates come down from those unbelievable highs. And this is an important thing. And the reason why I bring this up is, you could have the market valued at a certain level, but when interest rates are low, you get the benefit of having to discount less future earnings. And here's what I mean. And Buffett talked about this with regards to how you sort of have to value a company. If we think about, imagine you're a company or you're an analyst at a company and you say, look, we think we're going to have earnings, I'll use a nice round number, of $110,000 1 year from today. And so part of the way that you sort of value, the quote unquote value of a stock is the present value of future expected cash flows. And that could be a year out, it could be a couple years out. And of course, analyst expectations change, forecast change, guidance changes from companies. But if we were going to get earnings or free cash flow or a payment of $110,000 1 year from today, and interest rates are 1%, well, the present value of that cash flow in 1 year is about $108,910 and then some change. So it's very close to that. We call it, the present value and the future value. Anyone who's ever had to take an economics or rather a finance course probably spent a lot of time on present value, future values. But essentially what you have to do is you discount down a future value by whatever the risk-free rate is or some sort of discount rate. So if interest rates, though, were at 10%, that same $110,000 payment in a year would only be worth $100,000. So there's about an 8.9% difference, quite a bit of difference. In other words, when interest rates are really low, the present value is higher based upon future cash flows. So think about earnings in companies, and you're trying to put a value on a company based upon the growth of what you're going to see in a year from now or 2 years from now. And Buffett talked about that. He said, look, when interest rates are going up and you're trying to value companies, the more interest rates go up, the more you have to discount down today the value of those future earnings. When interest rates go lower, you don't have to discount it down as much, meaning those future earnings are worth more. And so that's why interest rates are so important. And maybe somebody out there will come up with a way to take the percent market cap to nominal GDP. And I said, right, the last calculation was right around 140%. Maybe they'll come out with a way to multiply that by some factor that adjusts it based upon the interest rate. But look, I mean, that's sort of the Buffett indicator is just a way to sort of evaluate whether or not, based upon where the market cap is to GDP, whether that relationship is on the high side or the low side. I've also heard people talk about if this is above 100, you think about maybe not putting as much money into stocks. And when it's below 100, that's the time to quote unquote throw money in stocks. Here's the thing though, when you look at this indicator, Buffett mentioned, or I referenced the talk in the article about 1964 to 1981, which is a virtual flat period of returns over 17 years in stocks. Going back, and I'll link to it, from 1951, it didn't go above 100% from 1951 all the way to 1997. And so that period that we talked about, that 1964 period, it was roughly, only around, 75% or so, 77%. And so you got to kind of look at this, and it's not necessarily saying, hey, it's the best time to go into stocks when it's below 100. You should run away when it's above 100. The thing with valuations, it always gets back to this idea of trying to time the market. And so, look, I mean, there's a couple things, just focusing on the indicator itself for a second, which again is taking the market cap divided by the GDP. There's a couple ways that this could change. The percent could go lower if GDP were to grow. And so if we start to see the economy continue to grow, if you see the economy grow more than the market cap grows, you would expect that number to come down. You could see corporate earnings continue to grow. And so this isn't, there's a lot of things that could affect this. You also could see interest rates change. And if interest rates were to change materially, goes back to the whole idea, you've got these future earnings or future cash flows that have to be discounted down. So that's one of the things to think about with any indicator. Now, the other valuation metrics that I keep getting questions on is the Shiller PE ratio. And so this is another one of these that are looking at earnings on the S&P 500 and trying to come up with a price to earnings, not in the current period, but averaging over a number of periods. And so the Shiller PE, of course, is you're looking at essentially 10 years, and you look at the yearly earnings of the S&P 500 over those past 10 years. You have an annual number each of those 10. And then what they do is they adjust the earnings for inflation. And so let's say you had earnings from 2008. You would need to inflation adjust those earnings to 2018 dollars, to today's dollars. And basically what happens is you take each of those years after you adjust for inflation, and you add the values up, you divide by 10, and that gives you your average inflation-adjusted earnings. And then you look at the price. So then the current price of the S&P 500 divided by the inflation-adjusted 10-year average of earnings. And what you get is the Shiller PE ratio. And so in the Shiller PE ratio, what they're trying to do there is try and figure out is the price to earnings, and again, I just explained how he does the earnings, Is that on the high side or the low side, and where is that? Well, just looking, and I'll link to a site which computes it and graphs it. So I'll let you take a look at the graph on that site. But the most recent one was about 33 and a quarter. To give you an example, right before the tech meltdown in 2000, it was close to 45. And if you go, this data goes way back to looks like 1929. The Black Tuesday, it was about 30. Black Monday, which is October of 87, that was roughly 17. So that's just another way of looking at valuation. And one of the things is, people always say, okay, I can look at valuation, but if I'm worried the market's too high, or if I have, what are the solutions? So I'll get into that. But there's, the Buffett ratio, the Shiller PE ratio. These are all ways to try and evaluate over time where the market is compared to where it was. It's not a predicting, feature. It's not trying to say where markets are going to go. And the really important thing, and if I remember who said the quote, I'll post it in a link. But it's this idea that markets can stay irrational longer than you can stay solvent. I think I got that right. And valuation is only one thing, but markets are also driven by supply and demand, by buyers and sellers. And you can see changes in earnings. You can see changes in the economy. And so, look, we don't necessarily know where the market's going to go. You can certainly look at these valuations, but you can look at these valuations and say, look, there was a valuation here and the market still did something. So really, the message continues to be the same. If you're an investor and you're in the markets, I think the best way to do this is not try and game this thing, not try and figure out when you think the market's overvalued, undervalued. I think it's better to just stay in the market, but be hedged. Be in strategies that put a floor in a portfolio, or be in strategies that put a buffer on the downside. And by doing these, and I'm going to link to two or three different episodes that we did where we talked about some specific strategies and how those look to change the risk profile. But I'll link to those. But the message is, look, just stay invested in the market, but why not be invested? And if you get the upside, great. If the markets go down, you have protection or buffers in there. And I could go on and talk about the whole idea. You've probably seen those articles. If you got out of the market and you missed the 5 or 10 best days in the market, you would have missed X percent annually and your returns would be much less. People also say, hey, if you missed the 5 or 10 worst days in the market, your returns would have been much better. But really, the only way to get the upside is to be in the market. The only way to avoid those 5 or 10 worst days is if you somehow could have predicted when those were, got out of the market, and then got back in. It's just really difficult over time. And so on valuation, hopefully that gives you you're going to be hearing about this stuff in the news media, whether it's the Shiller PE ratio or you're going to hear about the Buffett Indicator. They're just ways of trying to capture what valuations are. And look at it historically, and also, you tend to chart these things. But as far as strategies, stay invested, be hedged, be buffered. All right, folks, going to keep this one short this week. We'll be back next week with another episode. Hope you enjoyed this. And by the way, one of the things I wanted to ask everybody, everyone says, hey, rate my podcast, give it 5 stars, write a good review. Rather than do that, what I want to ask everyone to do is, if you think somebody would benefit from this or be interested in the conversation and the topics that were being covered here, share it. Send the link to somebody, and maybe they haven't been turned on to podcasts quite yet. A lot of people still, when I talk to them, they're not really sure what a podcast is. How do I get it? Is it a radio broadcast? What exactly happens here? So do your friends and maybe coworkers a favor and let them in on the what's going on with podcasts. And if you can share a link to my episodes, I would appreciate it. All right, folks, we'll see you next week.